2026 is going to be a very interesting year in property. The biggest prediction that I have is that the darlings of the last 5 years are not going to be the darling of the next 5 years, and you need to be careful if you're an investor. It's not going to be the year of you can buy anything, anywhere and do well. You need to be very careful and very selective with the suburbs that you're going to buy. I'm Ben from Compound Property Buyers Agency, and we help hundreds of clients purchase hundreds of investment properties across the country every single year. We use data to understand what markets are going to do well and when is the best time to buy. But today is very different. Today is about what not to buy. And some of these suburbs, funnily enough, we've bought in and had huge results. So it's not that they're bad suburbs, it's just the timing is not right. So in this video, I'm going to show you 5 suburbs that you should avoid for 2026. I'm going to show you the key metrics on each suburb. I'm also going to show you 3 reasons why I think you need to avoid them. Out of the 5 suburbs, you'll see that there's some very similar metrics as why I would avoid them, but the 5th one, I think you'll be surprised. It's completely different. And then I'm going to show you what I'll be doing in 2026. So let's jump into our first suburb. So here we are. This is a suburb called Inala. I hope I'm saying that right, and I'm probably not. It's in Brisbane. It's roughly 27 kilometers south of the CBD. It currently has a median price of $897. Now, typically for investment, we like investing between kind of 300 to 800. So it is getting up there price-wise, but it still can be good. So if we look into the numbers, I'm going to run through some metrics on all of these suburbs. So the 5-year growth of Inala is 124%. So think about that. In the last 5 years, it's done 124%. So it's doubled and a bit more. In the last 10 years, it's done 156%. So what you can see there is it's done well over 10 years, but it's done exceptionally well over the last 5, right? And that's something that we'll get to. As far as stock on market, looking really strong, 0.11%. There's a lot of demand, obviously, not much supply. Days on markets, things are selling in 27 days, so super tight market. The vacancy rate, 0.8%, not easy to get a rental if you're a tenant. And the renter to owner ratio is 55%. So it is blowing out. We typically like to see anything under 30% renters is good. So this is now becoming 55%. So on the whole, there's some red flags, but there's also some positives as well. So these are the 3 main reasons why I would avoid this suburb in 2026. Reason number 1 is the 5-year growth rate. So 124%. The way I like to look at it is having no more than 50% growth in the last 5 years. This particular suburb has 124%. Now, the reason that that's bad is when you're investing in property, you're not buying the past growth, you're buying the future growth. And if something has already doubled, then the chance of it doubling again in the next 5 years is a lot less. Reason number 2, renter to owner ratio is starting to blow out. So 55%. So that would have been creeping up. And the reason that happens is over time, as an area starts performing well, investors start piling in, and then suddenly the owner-occupied percentage starts to transition more into investment properties and more into renters. That's when it starts to become an issue. And reason number 3, and this is the number 1 reason that why I would not invest in this property in 2026, is the affordability ratio. So we use a metric on how many years does it take to own a property in a suburb. Now, different suburb prices have slightly different metrics about what's acceptable, but on a whole, around 35 years or below is an acceptable years to own in Australia. Now, this suburb, incredibly, has blown out to 73.92 years to own. So the way that I look at that, it is absolutely unaffordable for local residents, and that's why eventually the growth will stop. Let's go to suburb number 2 of suburbs I wouldn't invest in 2026. So here we are, we're in Brisbane again, and you're probably thinking, you're crazy though. What about the Olympics? What about all the things that are happening in Brisbane? Well, let's have a look, right? So we're in the suburb called Woodridge, which is a part of the Logan area, the local city council. So you've probably heard a lot of podcasts. A lot of people have made an incredible amount of money in Logan. So not to say Logan's been a bad investment, but let's have a look in 2026. If we have a look here, the suburb median price is $781,000, so a little bit less than the previous suburb, but still on the higher side, especially compared to its past. So as far as where Woodridge is, it's around 22 kilometers south of the CBD, or about 25 kilometers south, and it's in that Logan City Council. So let's have a look at the numbers now. So the 5-year growth of Woodridge has been incredible. 174%. So if you'd pick this market in 2021, you have done exceptionally well. The 10-year growth, which is quite surprising, I haven't seen this often, is 162%. So in other words, it's grown more in 5 years than it has in 10. And the reason for that, it would have had a few years of decline at some point in the last 10, and then it's really picked it back up in the last 5. Now, stock on market is still 0.33%, so it's incredibly tight supply. There's not heaps of property selling, so I don't see prices falling anytime soon. Days on market is 24 days, so things are selling very quickly when they actually do come online. As far as vacancy rate, it's ticking up a little bit. 1.46%, so it's definitely something to take into account and think about. And the renter to owner ratio is now 60%. So I think you might recall I mentioned, anything above 30% is something to take note of. Anything above 50% is high. Now we're pushing into 60%. So definitely getting into the high territory here. So as far as why it's a trap, I'm now going to go through the 3 main reasons why I think Woodridge is a trap in 2026. So the first one is obvious, right? The 5-year growth rate has been exceptional, 174%. What an area to invest in 5 years ago. However, that makes it extremely unlikely. So if you look at the 10-year and it's been 162 and we've got the 5 years done 174, hard to imagine the next 5 years is going to do much. In fact, it could decline from here, but I'm not saying that. Reason number 2 is the affordability has absolutely blown out. It's now sitting at 61.59 years. So you got to think about it like this. Once a property has grown so much, it then becomes unaffordable. That's why it stops growing, because effectively people can't afford to buy it. And that's when the growth really plateaus until incomes rise, a lot of time passes, and then it goes on a second run. So this is definitely something to be concerned about. Now, reason number 3 is different to the last one. Actually not a metric that we focus on too heavily when we're investing in an area if we're buying at the right time. But if you buy at the wrong time, it's a really important metric. And it is the IRSEAD metric. So that stands for Index of Relative Socioeconomic Advantage and Disadvantage. Okay, so that is the IRSEAD. I had to look up what that actually meant myself, but all I know it's the socioeconomics of a suburb. So the socioeconomics of a suburb, the system that we use ranks it out of 10. So in Woodridge is currently getting 1 out of 10. So it is a little bit of a concern. And the reason why, when properties are very affordable, the socioeconomics is less important because, as you've seen, a 1 out of 10 has done 174% in 5 years. So if you'd ruled that out, you would have missed out on all that growth. However, once it's hitting its affordability metrics and incomes aren't growing and they are typically lower than the average and unemployment might be a little bit higher, well, then you can really start to see a story of why this suburb will most likely stop growing at some point. Okay, so let's go to suburb number 3 that I would avoid in 2026. Now, this is one that is dear to my heart because I had a property there. I've just sold it now, and it is in Armadale in Perth. So we're leaving Brisbane now. We're going over to Perth. This particular area, it's around 30 kilometers south of the CBD. Now, it does have a little bit of a history and a little bit of a reputation. I remember when we were buying a lot of properties here, at certain points, people were a little bit hesitant, but we'll see how that has worked out. So the current median price now is $689,000. So $689,000, so still not too bad on the outset, which is okay. The numbers. So let's go through the numbers. So the 5-year growth in Armadale has been 143%. So the properties that we bought, some we bought for 400 and they've since sold in the 700s. It's been quite incredible how well it has performed. The 10 years is sitting at around 120. So the 5-year is above the 10-year. The days on market though, the market's still hot and I almost do kick myself a little bit. I think I might have sold just a little bit too early because it looks like the thing I sold has jumped up a little bit. The days on market is 15 days, still going very quick. The stock on market's 0.6. The vacancy rate is 1.2%, so it's ticking up a little bit, but not too bad. And the renter to owner ratio is actually not too bad in Armadale. It's 40%, so not as bad as some other suburbs. The thing, it was just on a side note, it was a little bit of a lesson with one of the properties I sold. You can go a little bit too early. So during mid-2025, Armadale had a bit of a flat period and it kind of looked like it was done, but they then introduced the 5% deposit scheme, which look, was a bit of a, anomaly. And whether or not that was the actual reason, but it has driven the prices up a bigger run again. And even the agents that I deal with, they're pretty surprised at how much it's driven up beyond where it was. So just a bit of a side note. So the reason why I don't think Armadale is a good buy now is firstly, it's had the huge amount of growth. So reason number 1, it's had 143% growth in the last 5 years. So it's a tremendous amount of growth. The affordability, like the other properties I've shown you, has now blown out to 49.5 years. Now, remember I said anything below 35 is good. At the time we were investing here, it may have even been in the 20 years, right? So that's a really good indicator of how much room it's got to go. It's a 49.5. And then the third reason, like I said, it does have a bit of a reputation, which is not a bad thing. At the start of investment, when prices have really risen, you need to be really mindful of that. And the IRSEAD, which is, I remember, is the socioeconomic metric, is coming in at 1 out of 10. So you do need to be careful of a suburb that has grown tremendously over the last 5 years, has a low IRSEAD. So basically, in summary, an area that has grown substantially in the last 5 years is now hitting relative affordability caps and has a low socioeconomic kind of population, is a suburb that you should probably avoid in 2026. So let's go to suburb number 4 of suburbs I would avoid in 2026. So we've done 2 in Brisbane, we've done 1 in Perth, and now we are going to one of the darlings of the last 5 years, Adelaide. So the suburb that we're looking at is Elizabeth in South Australia. So as I mentioned, it is in Adelaide, and it's around 25 kilometres north of the CBD in Adelaide, up in that northern region. So let's have a look. The median price of Elizabeth is $718,000. Now, on a side note, we just had someone who chose not to work with us and they ended up buying themselves, and they said that they ended up buying in Elizabeth because it was cheap, right? And that is a really big red flag. So I'm going to go through that because 718 doesn't sound too bad for a capital city like Adelaide, but let's have a look now. So on the numbers, the 5-year growth of Elizabeth has been 172%. So exceptional. In fact, it's been the highest performer out of the other suburbs that we've looked at today. The 10-year growth is probably the highest that I've seen, or one of the highest I've ever seen. It's 206%. It has grown, which is just incredible, 20% per year for the last 10 years. So it's been incredible. The stock on market, it's still tied, 0.39%. So it's not much for sale there still. So I'm not saying prices are going to drop tomorrow, but let's have a look how much growth it's got. Days on market, 45 days. So still pretty strong. Things are selling relatively quickly. It's probably ticked up a fair bit. I would have said in the true boom of the suburb, it could have been as close as 15. It's now at 45, so things are probably slowing. The vacancy rate though, still tight, 0.52%. So no issues getting tenants if your property becomes vacant. And the renter to owner ratio is 53%. It's probably just a good note to say that if you look at some of these metrics, like in isolation, you could probably say it's a good suburb, like it's got a tight vacancy rate, days on market are low, stock on market are low. See what I mean? So you've got to be careful in not just looking at a few metrics in isolation. You have to look at the bigger picture. And we're going to go into the 3 reasons now why I wouldn't buy in Elizabeth. So the first reason, like all the others, is that the growth in the last 5 years has just been exceptional. So very well done to anyone that bought in Elizabeth. 172% you've had in 5 years, which has been incredible. The second reason is the affordability is blown out. So like I said, once an area outperforms significantly, then the affordability becomes too high. So it's currently sitting at 62.85 years. And I'm sure 5 years ago, it was probably sitting somewhere in the 20 years to own. It's now triple at 62 years to own. So for us, way too expensive relative to local income. So 718 sounds cheap, or lower price if you're living in Sydney or even Melbourne. But as far as locally for Elizabeth, 718 is getting quite dear. And then the third reason, similar to the other suburbs, and there is a little bit of a trend or a pattern that we're seeing, the IRSEAD here is 1 out of 10. So I want to reiterate the point though. I'm not saying that in a negative as in don't buy in the suburb, because as you've seen, these suburbs have been incredible. And one of the biggest pushbacks that we get from clients over time is like, I don't like the area, or even better, my friend that has been there once, maybe he doesn't like the area, or I've read somewhere that the area has high crime or it's not very good. And that may well be true as far as it's not where you want to live, or it's not somewhere that you want to necessarily visit for a holiday. But as far as growth, and that's what we're here to do, that's what the investment's about, these areas can be exceptional, as you've seen. These are some of the best performing suburbs over the last 5 years. But it just shows you not everything goes up forever. And at some point they will stop. And my prediction is in 2026, probably towards the end, we will start to see a significant slowdown across these areas. Now, let's go to the 5th and final worst suburb of 2026. And this one, we're going to go on a little bit of a different path, right? So this suburb is actually not in Queensland. It's not in South Australia. It's not in Western Australia. It's actually in my favorite state at the moment, and it's in Victoria. So the suburb is called Beveridge, and it's not a place to get a drink. It is a suburb in Melbourne, and it is roughly 45 kilometers north of the CBD. What I would recommend is watching my video on Melbourne, because I do think that 2026 is going to be an incredible year for Melbourne. However, this suburb, there's some things that you need to look at that can make this one of the worst suburbs to buy in. So let's have a look at the numbers. Now, This is chalk and cheese compared to the others. So the 5-year growth rate, 32%. So typically I'm looking at that and saying this is good. We're liking this. Anything under 50 is good. The 10-year growth rate, 72%. So it shows it still tracks pretty well, 72%, but it has underperformed. It's done 1/3 of the growth of Elizabeth, for example, over a 10-year period. Now the stock on market, 0.56, so not too bad. Things are okay. Days on market, 52. So quite a fair bit higher than you're seeing in other markets. But that's not too bad, to be honest. You can get some in the 100 days. So 52 is not bad, but it is not a hot market, for example. The vacancy rate, though, this is pretty incredible, 8.94%. So very, very difficult to get a tenant. So typically a 3% is a balanced market. 1% or less is extremely tight. 8.94% is probably anywhere from 8 to 16 weeks to get a tenant. Somewhere like that. And it means there's very little rental growth coming. So it's not good. And renter to owner ratio, funnily enough, it's only 17%. So there's actually not much rental stock there. There's only 17% compared to owner occupiers, but clearly no one wants to rent there. And that's a big problem. So let's have a look at why this is a trap. So it's funny because this is completely different to the others. The cycle timing of Melbourne is much better than Brisbane, Adelaide and Perth, right? But it doesn't mean that every suburb's a good buy. So with Beveridge, there's 3 main things that are a concern. The first one is the vacancy rate, 8.94%. So extremely difficult to get a tenant. It just means there's far too many investment properties. The problem this place has is it's a very house and land package area, and that's the problem. All these investors have bought or built these properties without much tenant demand. There's not much infrastructure out there, and as a result, the vacancy rate is really high. The second reason is the amount of building approvals. So you might have heard the saying that supply is the enemy of growth, and it is true. So essentially, if there's too many new properties coming on the market or being built, then it's going to reduce, in a way, the capital growth of this current supply, right? Because if you can just add more properties, then it really does limit how much growth you can have in the short term. Now, in the long term, we've seen many examples that once the stock gets kind of sucked up and people start moving in there and they stop building, then that starts to grow. But in the early phases of kind of a greenfield estate, the growth can be limited. Now, not always, but in a lot of cases. So this particular area has 537 new building approvals, which is 11.05% of the total available stock. So that's massive, right? We typically want 3% or less, right? Even less than that. A lot of like good suburbs of 1% or less than that. So there's a huge amount of building approvals. So what that means is if the vacancy rate's already bad and the capital growth's already been limited, then I don't see that getting fixed anytime soon. And the number 3, now this is a bit of a sad metric actually, because as a result of underperforming properties and high vacancy rates, the third reason is very short holding periods in Beveridge. So 4.67 years, right? So that's far below the average holding period. What it means is people are either investing there or they're moving there and they're just simply not either liking their investment, they're not happy with it, which fair enough, you wouldn't be, or they're moving there and just not liking it because the amenities aren't there, the infrastructure's not there yet, might be too far from the city for them, and they're moving away. So that is the third reason why I'd avoid Beveridge in Melbourne in 2026. So now I've run through 5 areas that I would avoid in 2026, and you can see some really common threads. There's a few things that I don't like to see when I'm looking at a suburb. One, it's done really well over the last 5 years. And now I know that sounds kind of counterintuitive, but for me, it's probably one of the most important things. Couple that with the affordability locally. If locals can't afford to buy there, then you can't expect to get much growth. And what it shows me for 2026 is that the darlings of the last 5 years are not going to be the darlings of the next 5 years. We are at an inflection point in the market. So what should people do in 2026? Well, what they shouldn't do, we know, is not focus on what's been working the last 5 years. You have to think about what's going to move in the next 5 years. So I have filmed a video, so you can watch my video, my 2026 best suburbs to buy, which are going to show you the areas that I think are going to boom over the next 5 years. So I hope I've given you a bit of information. If you want to go out and research yourself, you've got a few metrics now that you can read and understand what not to buy. However, if you do want help building a property portfolio and buying the right area in 2026, reach out to us at Compound Property Buyers Agency as we help clients buy high growth and high cash flow properties across the country. Link in the description below.